Home sweet home. Such a joy. But home loans, what about them? Let's talk about home loans in your debt-free journey. Home loan is one of the biggest liabilities for majority of the people who buy houses. Most of them stretch their eligibility for getting the highest possible home loan amount, and hence the repayment period becomes quite long, spanning over 15 to 20 years. However, most borrowers prefer to get their house debt-free as soon as possible. But even though many want to pay it off as soon as possible, they are often unable to do so, either due to lack of awareness or shortage of funds. However, know that with a small increase in EMIs, you will be able to repay your loan faster, which works better in a falling interest rate regime. For example, on a loan of 30 lakh at 8% interest, just increasing the EMI by 2,000 rupees can reduce the tenure from 20 years to 16 years and 10 months and save you a total interest close to 6 lakhs. Increasing your EMI will just not assist you in getting rid of your liability faster, but also help you save big on the interest outflow. Generally, the longer the loan tenure you opt for, the higher the total interest you pay on your loan. And because of the size of the home loan, most home loan borrowers stretch their budget when buying a house. We know that. Hence, it becomes difficult to churn out some extra in the initial years. Experts say if one is able to control one's expenses, the affordability level improves typically over 3 to 5 years after buying a house. So try to reassess your repayment capability then and increase the EMI, even if by a little. And even a small increase, say of 2,000 as we saw, brings down the remaining loan tenure significantly. But what about falling interest rates? When the RBI cuts the repo rate, it soon reflects in the loan rates with a fall. Now, what is the repo rate? Repo rate is the rate at which the central bank of a country, Reserve Bank of India in case of India, lends money to commercial banks in the event of any shortfall of funds. Interest rates usually trend downwards, at least for some time post a rate cut. And we recently saw a 40 basis point repo rate cut, so it came down from 4.4% to 4% in May 2020. And interest rates on home loans offered by banks are now linked to an external benchmark, and the RBI's repo rate is one of them, and most banks have chosen the repo rate as their choice of external benchmark. According to experts, the falling interest rate scenario is the best time for home loan borrowers to bring down their outstanding. In a falling interest rate scenario, the lender gives two options to the borrower. He or she can either reduce the EMI or reduce the tenure by paying the same EMI. The ideal option is to not opt for a lower EMI if your budget allows it and get the loan tenure decreased instead. For instance, if you keep your EMI constant in a falling interest rate regime, then for every 0.5% fall in the interest rate, your EMI tenure reduces by approximately 4%. Make partial prepayments. Go for partial prepayment if you have some surplus fund in hand. With floating rate home loans, there is no penalty on partial prepayment. Making partial prepayment brings down your outstanding instantly. While some lenders have a restricted number of partial prepayments, some allow any number of partial prepayments. Hence, check this with your lender first. You can make prepayments with small gains like a bonus, incentives, and arrears. But when not to go for prepayments? If your home loan amount is lesser and you prefer tax saving, then prepayment may not be the right option for you. Investors in the 30% tax bracket and whose outstanding home loan balance is less than 20 lakh and the annual interest outflow may fall below the 2 lakh deductible limit may find good tax-free investment options in the market, and hence prepayment in such a scenario may not be a good option. So do check for the tax benefits before making the final call. And that's it. If you have found today's video to be informative, then please share this on your Facebook, Instagram, WhatsApp it to your friends, family, and your communities. All it takes is a forward to pay it forward. And if you are in debt and have been struggling to bring velocity in you reaching your debt freedom, then please sign up for our intensive Debt to Freedom program. The link is in the description of this video. At Women on Wealth, many women have become debt-free and many more are on their way, and you can join them too. I thank you for watching and I will see you next time. Bye bye.